So guys, take up one last model on options hedging. Last we solved question number 4, I guess. Pick up question number 11. Question number 11 is also on the same model. Yeah, XYZ, an Indian firm, will need to pay Japanese yen 5 lakhs on 30th June, so they have a yen payable. In order to hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods. One is forward market cover and currency options. So only two options here, means two choices. One is forward contract hedging, the other one is options. On 1st April, the following quotations JY by INR are made available. So spot rate bid ask given, forward rate bid ask also given. The price of foreign currency option on purchase are as follows. Strike price Japanese yen 2.125, that is the strike price of Japanese, means strike price given there. Sir, if somebody tells you, suppose you have a dollar payable, sir, okay, and somebody tells you the strike price is rupees 85, what does it mean? You have a dollar payable and strike price is rupees 85, what does it mean? Strike price is $1 is equal to rupees 85. Like that, here also if somebody tells you strike price is Japanese yen 2.125, Japanese yen 2.125 is equal to some other currency. Who is that other currency here? Indian rupee only. So here you must understand that it is given as 1 rupee is equal to yen 2.125. Continue. Then call option Japanese yen given, put option Japanese yen given. These two are, you must understand that they are premiums. So in option hedging, the question will give you only two data. One is strike price, the other one is option premium, and of course sometimes they'll give you lot size. And he says for excess or balance of JY covered, the firm would use forward rate as future spot rate. You are required to recommend cheaper hedging alternative for XYZ. Sir, in this sum again, what is happening is you have a FC payable in yen. Forward contract hedging is easy only, that's no big deal. Coming to options hedging, here the underlying asset is rupee currency. How do you know underlying asset is rupee currency? Look at the call premium, put premium. Call premium, put premium are in which currency? Yen. If call premium, put premium is in yen, underlying asset cannot be yen. Underlying asset should be rupee. So you have to take either call option on rupee or put option rupee, exercising your judgment correctly. Okay. And strike price is 1 rupee is equal to so many yen. Chalo sir, solve quickly. So question number 11. XYZ Indian company has FC payable of 5 lakh yen on 30th June. It is 3 months from now. Today is 1st April, sir. Alternative 1. Forward hedging. They have given you the 3 months rate. Go pick up that and means appropriate bid rate, ask it and finish it off. So question tells you that 3 months forward rate is 1 rupee is equal to yen 1.9726, 1.9923. Sir, I have FC payable in yen, so I have to pay yen, means I have to buy yen from the bank by giving rupees. Quote is given for rupees. I am giving rupees, bank is buying rupees. Bid rate will be selected. But if you have any doubt, please draw the diagram and identify. So XYZ has an obligation to pay yen. They will have to buy yen by giving rupees with the bank. Quotation is given for rupee. You must think what is bank doing with the market currency. Bank is buying bid rate. 1 rupee is equal to yen 1.9726. How many yen is this? 5 lakhs. So 5 lakhs yen proportionately work out. 470. Alternative 2, please do on your own now. So identify how many routes are possible, which route you have to select and all. Make all the judgment, get a conclusion there. What is the risk involved? Yen may increase or rupee may decrease. So your two routes of hedging is route 1 buy call on yen, or route 2 buy a put on rupee. What you have to observe is in the given question, from the data you can observe that underlying asset is which currency? Rupee currency, because premium and all is given in yen. So underlying asset is rupee. So you have to select only route 2. In given question, underlying asset in option is rupee. Premium is in yen currency. Therefore, company has to buy put option on rupee with a strike price of 1 rupee is equal to 1250 at premium of 0.098 per rupee. The first judgment, sir. In this, if you make it wrong, then that's all. Over sum here only. Only forward contract 2 marks you will get. Do here onwards. Everything if I will only do, what will you do? Ideally I should leave this. Sir, is similar lot size is given or not given? If lot size was given, you have to first work out the number of contracts you have to take. Lot size is not given. Since lot size is not given, you will do full proper hedging without any limit. What are you writing next? Up to here you wrote, no, you copied. After that, what is the next step? How much premium payable? 0.098 yen per rupee. So this you have to multiply with something, no? Multiply with what? You want to calculate option premium, correct? 0. Into what? You have to first work out you put options ka value. You put options, sir, put options how much value I should take, sir? Ante see, your underlying asset is not yen. If your underlying asset was yen payable is how much? 5 lakhs. So 5 lakhs yen if you take call option, that is okay. But put option you are not, but option you are not taking on yen, option you are taking on rupee. Rupee ki 5 lakhs equivalent you have to work out first. Yesterday we did no best of luck limited, same sum. 5 lakhs yen ka rupee equivalent I want. Sir, to be converted, what rate, sir? Strike rate, not spot. The options are strike rate is there. So first, without doing that, how will you work out premium? 1 rupee is equal to yen 2.125. Sort out this. 2,30,000 94 rupees. Value of put options to be taken is equal to is rupees 235 294. If we have to hedge FC payable of yen 5 lakhs. Suppose you are doing call option hedging, then answer would be very simple. Buy call options worth 5 lakh yen. But since you are doing put option hedging using rupee as underlying asset, you must be hedging 234 294. Question of one trap he has put for you. What is that is? Any under hedging, over hedging is there, you will take forward contracts and all. But under hedging scenario will come when lot size is not. Lot size a question are not there, no. So you will assume that one contract is equal to 1 rupee. So full 235 294 rupees ki you will be able to enter. Now I'll work out option premium. Premium is equal to rupees 235 294 into rupees, not rupees, yen 0.098 per rupee. Sort out this. .81, no? Which currency is this? 23058, huh? Correct. What is this? Yen. Sir, if you hedge using underlying asset as your home currency, premium will be in foreign currency. So you have to pay now. So what is spot rate? Go and check. Otherwise, why will you give you spot rate? 9516. I have to pay yen, so I have to buy yen, I have to give rupee, quote is given for rupee, bank is buying rupee, bid rate. Sir, without practicing you are taking extremely high risk. Sort out this. 11,815.35. Oh, okay. What is this now? Rupees. This is your outflow today. Sir, on maturity date, what will happen will depend on what? Will depend on your spot rate of 1 rupee in the market. Questionless spot rate is not given. So what will happen? You will assume that the spot rate will be at such a rate where option gets exercised, and therefore you will buy N in the open market at spot rate, and you will also settle the put option. Payoff also you will receive. Effectively, your outflow will be equal to strike price. Appoint to rate and close. Spot rate at 30th June is not given. We assume that spot rate would be at such level where put gets exercised. Once put is getting exercised, what will happen is, therefore, company buys N at spot rate plus receives payoff in put option. Your net outflow will be equal to strike, and strike price is 1 rupee is equal to, what was the question, 2.125. is already been sorted out. This is 235, 294 rupees. Therefore, outflow in options hedging is equal to 235, 294 plus 11,815. Leave chiller, sir, to total this. Obviously, time value is ignored there. Write the conclusion who is best. Option of? Okay. Option hedging is to be selected. Sir, with this your options hedging story is over. In fact, we have little overdone also. That many sums I did not teach. 1 or 2 should be fine. But anyway, it's okay. Continue. Put the heading. Hedging using currency futures. Hedging using currency futures. 5-6 points you write, then we'll go and do a few questions. Futures contract is an exchange traded contract. Currency futures means the underlying asset in futures contract is currency. A long position in currency futures means we have agreed to buy a currency in future means again a futures की future word you will get confused at a later date for a predetermined futures price. Tell me, sir, long position when will you take? When is it beneficial? When the market price is going to increase. Our point also right. A long position is taken when the spot rate of underlying currency is expected to move up. A short position indicates an agreement to sell currency at maturity date for predetermined futures price. Short position is beneficial when spot rate of underlying currency is expected to move down. When future contract is entered and held till maturity, there would not be any physical delivery of underlying currency. The gain or loss is cash settled between the parties. tell me, sir, how to get this here gain or loss position. So no, wait a moment. At maturity date, spot rate greater than actually future spot rates are on the maturity date, but if I use the word future, our future if futures you may get confused. Copy this. Same point only. The same point, gain or loss statement you are trying. Guys, if you have taken long position, you have agreed to buy at futures price, but market rate is higher than that, definitely this will give you a gain, and that gain is not simple gain. You'll receive money for that inflow. And if spot rate is lower, you agree to buy at a higher rate, then in which case you will suffer a loss. Here, loss and gain. All this you know, sir, but just you know, safe side. When you're revising, it will be easy for you, sir. All this you can revise in just 5 minutes. Fourth point is done. Point number 5. If futures contract is not held till maturity, what can the company do? For example, I need hedging only for 2 months, but at 2 months time I see the futures contract still have expiry of another 15 days. What should I do? You exit. The company may exit or square up or prematurely settle the futures by entering into an opposite position. For remaining maturity period. Sir, if you do this, what will be the gain or loss? You know this. Premature settlement, what is the answer for gain or loss? Sell rate minus buy rate. Sir, sell rate money, which rate? Short position का price, short positions futures price. Buy rate means long positions futures price. That's all, ma'am. Basics are done. Now we have to do the hedging action. Hedging FC receivable. Now that options you did this analysis, this will be very easy for you. So there is an Indian company. They are having a dollar receivable at 3 months from today. When they receive the dollars, they are going to convert the dollars into their home currency by giving dollars, selling dollars and receiving rupees, which I am calling also as buying rupees. So here risk involved is, you can say, dollar may fall or rupee may rise. Both are same thing, only different expressions. Any of this happens, I'll suffer a loss. So hedging route 1. Dollar is likely to fall, sir. I want to hedge. In a falling market, which position will give you short position? Short position in futures with dollar as underlying currency or underlying asset. Rupee may rise. If rupee rises, I'll suffer a loss in real market. So you have to gain in futures market. So rising market la long positions will give gain. Long position in futures with rupee as underlying asset. Now between these two, which one? That depends on who is the underlying asset in the given question. Generally they will give you. If they don't give you, look at the lot size and identify. That's all. Premium is not applicable in the futures. Same to same example, right, for payable. Risk involved is, I'm going to buy pound at a 3 months time, so pound may increase, or I'm going to sell rupee, so rupee may decrease, fall. So hedging route 1. Pound may rise, so long position in futures with pound as underlying asset, or hedging route 2, rupee may fall, falling market short position. whether to use route 1 or route 2 for hedging depends on underlying asset currency given in question. So you have to read the question carefully. If question does not specify underlying asset currency directly, we can identify from lot size. Lot size currency is underlying asset currency. Sir, on maturity date, futures contract low delivery is not possible. You have to only cash settle them. So whatever dollar you are receiving from your customer, or whatever pound you have to pay to your supplier, that you have to buy or sell at what rate? Prevailing spot rate in the market. But if ideally you hold the contract till the maturity date, if you hold the contract till the maturity date and futures market is perfectly functioning, your effective inflow or outflow will be equal to futures price. How it will be equal to futures price? Think carefully. Imagine, sir, you want to buy A Limited ka share after 3 months. Forget about currency, it will be confusing. Currency will update later on. Also, a share case we'll see. You want to buy a share after 3 months. Your worry is after 3 months, the share price will increase. So risk is price increase is a risk. So what is the action you will do? You will take a long position in futures. Imagine long position in our company share futures you have taken for let's say 500 rupees. Now 3 months you held the contract. Market low price is 540. I am telling you, if futures contract low, there is no physical delivery. So what I have to do? I have to cash settle it. So market low share price is 540, but I agreed to buy it 500. Gain or loss? Gain. How much gain? 40. A 40 I'll receive inflow. Yes, a 40 rupees is in your pocket now, inflow. But now you really want to buy the share. From where will you buy? Open market low you buy. Open market low, what is the price? 540. 540 is outflow. So two transactions are separate. First transaction of 40 rupees inflow, futures market. Second transaction low, share buying outflow 540. Effectively your outflow is how much? 500. What is 500? Futures price. 500 is nothing but your futures price. That means if physical delivery is there, happily you will take the share ka physical delivery. Cost will be 500 only. If physical delivery is not there, only cash settlement of gain or loss is there, then also your cost is effectively 500 rupees only. Likewise, same, remove the share, put dollar in that. So let's say I have a FC payable. So I have to pay dollars to somebody by buying dollars at 3 months time. So what is the risk involved? Dollar rate may increase. So what did I do? I took a long position in dollar futures at say let's say 85. So I waited for 3 months time. I saw in the market price is 90. $1 rate is 90 rupees. So what I have to do? I have to buy each dollar in the market at 90 rupees and I have to make the FC payable settlement. I did. What is my outflow now? 90. But futures market I agreed to buy at what rate? 85. So I agreed to buy at 85. Spot rate is 90. Gain is how much? 5 rupees. 5 rupees you'll receive as inflow. So in cash market, when you have to buy the dollar, it costed you 90. Futures market gave you compensatory gain of 5 rupees. Effective outflow will be equal to 85. 85 is nothing but your futures price. That means if you hold the contract till maturity, and it is a case of perfect hedging. Perfect hedging means a lot says the chiller and all should not be there. Perfectly it should hedge. In that case, your effective realization of your FC or effective settlement of your FC payable will be equal to futures price. A point also you write. After doing futures chapter, you should not have this doubt, but safe side. On maturity date, we have to, number one, settle our gain oblique loss in futures market. We will, or we may get gain. We may get gain in the sense, understand that I'm talking about inflow, or suffer a loss, which is outflow. We have to buy oblique sell foreign currency. Why am I saying buy oblique sell is because I do not know whether you are a importer or a exporter. Exporter is a receivable, so he will sell foreign currency, whatever he receives from the customer. Importer has a payable, so he has to buy foreign currency, whatever as the case may be. At prevailing spot rate, and settle FC payable oblique receivable respectively. So as the case may be, buy is for payable, sell is for receivable. If perfect hedging is done, then the effective realization, okay, wait, then the net effective rate, then the net effect of above two steps would be effectively equal to futures price. So in any question, they don't give you future spot rate on the maturity date. There is nothing to worry. Like how call option of future spot rate, when they did not give, you assumed what? You assumed that spot rate will be such a rate where call or put will get exercised, and effective answer is strike price, and you assume no. Here, there, why you have to assume like that is call option lapse ki chance is there. With the futures contracts, sir, you cannot run away, no. Definitely it has to be executed. So pakka it will be equal to futures price, provided what? Perfect hedging should happen, and you should hold the contract till the maturity date. So your contract ka means, I mean to say, your FC receivable payable date should match with the futures ka maturity date. Then only this will happen. Futures lo prematurity settlement chesaru anukondi sir, then this effective price will not be equal to futures price, because there will be having two futures prices now, buying rate, selling rate. So this will work only when maturity work you hold. That's all, sir. You can do questions. Okay, first come to question number 11. Sorry, question number 10.
Babu. ABC Technologies is expecting to receive a sum of $4 lakhs at 3 months. Expecting to receive means FC receivable.
The company decided to go futures contract to hedge against the risk. The standard size of future contract available in the market is $1,000. So underlying asset is who now? Dollar. First tell me, which futures contract did you take? Futures contract on dollar only he will take. Which position is that? Only one choice. Fast. I have a dollar receivable. So a dollar I will receive and I will give it to the bank. So I am selling dollars in future. Risk is dollar rate may fall. In the falling market, which position? Short position. So you would be taking a short position in dollar futures. As on sale means on the first day, sale date. Spot and futures dollar contract are quoting at 44 rupees is the spot rate, leave it, and 45 rupees respectively. So basically this is your story, sir. You took futures contract low, short position. At what rate? $1 is equal to rupees 45. What's the lot size? $1,000. How much you want to hedge? 4 lakhs. So how many contracts you have to take? 400. 400 contracts you have to take. Tell me, sir, is perfect hedging or chiller is there? Perfect hedging. Continue. Suppose after 3 months time, the company closes out its position, futures close out its position, futures are quoting at 44.5 and spot rate is also quoting at 44.5. Sir, future rate is spot rate. Why are they equal like that? And the maturity dates are pictures are why will they be equal? Spot rate, futures rate, both are same means understand they are standing on the maturity date. Now what will happen? You have to settle gain and you have to settle FC receivable separately. FC receivable will be how much? $4 lakh. You will sell in the open market at what rate? 44.5. Take your calculator and multiply 44.5 into $4 lakh. 178 lakh rupees you are getting, plus futures contract gain also you will get. Why will you get gain? You took a short at 45. Today market rate is 44.5. So agree to sell at a higher rate. Definitely gain. How much? 50 paisa gain. 0.5 into 0.5 rupees per every dollar into 4 lakhs. 2 lakh rupees gain. So total your inflow will be 180 lakh rupees. At what time? On the maturity, 3 months time. You are required to calculate effective realization for the company while selling the receivable. What is effective realization means? Ultimately 4 lakh dollars got converted into how much money? 180 lakhs. Go divide it. 180 lakhs divided by 4 lakh dollars. That will be how much? 45. 45 is nothing but what? Futures price. That will be futures price. This is the last point example. So what you do is, 8th point you wrote, no? The third point here you write, refer question 10 and write, because anyway I am not solving that now. Now let us try to understand when this rule will fail. When this rule will fail is, on the maturity date, spot rate is 44.5, futures price is something else. Then definitely effective realized price will not be equal to your futures price. Of course hedging will happen, hedging will definitely happen, but perfect hedging may not happen there. Sir, they both will be equal now, sir. Arey sir, they are equal. But do you remember while doing futures, we did one somewhere, that fellow did wheat futures. 3 months wheat futures, rice futures, one some we did. That fellow held the contract till maturity only. But on the last day, cash market lo spot rate, futures market lo price, they both are not same. Small decimal difference was there. So gain or loss is computed only using futures market lo price, not cash market lo spot price there. So small difference can occur. So eventually a rule may not work also. So you have to watch the questions carefully. Sir, there is one thing, sir. Theory, story is one thing, reality is one thing. In the exam, both are being tested. That's a problem. Complete theoretically, they are asking, we can remember, pakka they will be equal, sir, I can tell you. Majority of the questions, they will be equal only. In 1 hour question, he will say that futures price and spot rate are not same on the maturity date only. So I have to tell you how it works in reality also. So there student gets confused. There is nothing to get confusion. Already we have seen this case, we are prepared for this case. Chalo, so let's do a proper question now, the cheap question. Come to question number 7. You can mark how many stars you want, that many stars. Each star is 20 marks. So mark how many stars you want. It is highly important, sir. It came many times. Our exam references RTP, MTP, Ferret, that is coming to 2-3 lines. So I removed that. The latest I wrote. Highly important. Go through it. XYZ Limited is an export-oriented house based in Mumbai. The invoice in customer's currency, means foreign currency. Its receipt of $1 lakh is due on 1st September 2005. So September 1st receivable is there. Market information as at June 1, 2005 is given. So standing on June 1, how much is the remaining period? June, July, August, 3 months. Exchange rate, dollar per rupee, spot rate is given. 1 month forward is given. 3 months forward is given. Currency futures, dollar per rupee model, June futures ka price given. September futures ka price is also given. And then he tells you contract size is rupees 4,72,000. So contract size means what? Lot size. Lot size is in which currency? So underlying asset is rupee. Now you see guys, I want hedging up to what date? Till I receive my money, I want hedging. September 1st. You have given 2 futures. One is June futures, one is September futures. June futures will expire when? June ending. September futures will expire at September ending. So which one will you take? Obviously September futures you will take. Why will I take June futures? If I take June futures, that will get expired in current month only. August, July and August months, I will remain unhedged. Other September futures if you take, e contract when will it expire? September ending it will expire. But I want hedging up to 1st September. So what you will do? You will exit on 1st September. Ultimately hedging is provided or not. So in the center question, wherever June is there, adanta waste information is a trap. Why will he give you 1 month forward, stupid fellow? By mistake you will take this and add as don't touch this. This also don't touch. Why will you take 1 month forward, sir? I have a receivable at 3 months time. I'll take 3 months forward if I have to do forward contract hedging. Similarly, for futures contract, you will take up to September. June ka data is completely irrelevant. Continue. Initial margin per contract, interest rates. Okay, if you take June futures, you have to pay 10,000 rupees margin money. September contract, if you take, adi 15,000, sir. Dot convert to comma, 15,000 rupees. Interest rate is 8%. Sir, why margin is given, sir? See, when you work out the number of contracts, you will also understand how much margin you have to pay. For example, you have to enter into 10 contracts. 10 into 15,000, 1,50,000 you have to pay. If 1,50,000 is permanent outflow, or will they give it back? They will give it back. When will they give it back? When you are out of the futures market, then they will give it back. So, 2 months ko, 3 months ko, your money is blocked, no, on that opportunity interest cost is what you have to compute. For that purpose they are giving. It is not like option premium. Option premium, once you pay is gone, the outflow. This is not outflow like that. The outflow, again it will come back inflow also. Net difference is nothing but your opportunity interest cost. That you have to factor when you do futures hedging. On September 1, 2005, the spot rate is dollar per rupee is this thing 0.2133 and currency futures price is 0.02134. Observe closely. September 1 is it the maturity date of futures contract? Definitely not. That is the reason on this day spot rate to futures price are not same. They should not be same on this day. Comment which of the following methods would be most advantageous for XYZ Limited. You have 3 options, sir. Forward, futures, no hedging. it may be assumed that variation in margin would be settled on the maturity of futures contract. What is the meaning of variation of margin? Sir, why will margin account balance change? Tell me. Gain or loss? The gain or loss. He says gain or loss will be settled on the maturity of futures contract. E point if it is not there also we will assume anyway that only. But why he is giving that is, since he gave you margin ka adjustment, you may think of doing a daily gain or loss ka full statement. If you have to do that, next 3 months every day price they have to give you. Not given, no. So he says directly settle on the maturity date. The covering, sir, a line if it is not there also that will not make any difference for us. Chalo, enjoy. Question number 7. XYZ Indian company has a FC receivable of how many dollars? $1 lakh on 1st September 2005. That is 3 months from now. First we'll finish off easy one, sir. Alternative 1. Forward hedging. Single quota, two-way quota. Single quota. See how simple life is. 3 months forward rate. 1 rupee is equal to $0.02 127 $1 lakh. Write it below dollars and convert it. You need not convert the rate, sir. Write it below that corresponding currency, automatically you will get conversion. 47 lakhs. 47, okay. Point. Leave it. This is inflow at 3 months. See how simple it is. Forward hedging, always easy. Alternative 2. Futures hedging. So think XYZ Limited has a dollar receivable at 3 months time. So in future he will sell dollar and he will have to take rupees. So risk is, those lines only are risk also. So based on that, give action for hedging. Route 1. What is route 1? Short futures or short position in futures. Short position in dollar futures. Or route 2. Long position in rupee futures. In this sum you have to do which one? This one, route 2. Contract size is rupees 4,72,000. Therefore underlying asset is rupee currency. XYZ should take long position in September futures with rupee as underlying asset at the price of 1 rupee is equal to 0.02118. Here, just for hint, I'm making you write September futures, you underline, put a arrow mark outside and write expires at the end of September. Because if you are able to read that here, final climax, what is going to happen, you will get a hint of that. Normal futures chapter we did all this, sir. A crude oil future sums and all are similar. You took a long maturity futures to hedge a short period. Sure. Next. How many contracts you have to book? How will I know? Lot size is 4,72,000, but FC receivable is in lakh. What you have to do? First, $1 lakh you have to convert into equivalent rupee terms using which rate? Futures price. Futures price. Right now. Next line, right. 1 rupee is equal to $0.02118. $1 lakh is equal to 430. What is that calculation? What is the meaning of that calculation? We'll write. It means that to hedge FC receivable of $1 lakh, we should take long position in rupee futures to the extent of this number 4721 435. Number of contracts to be taken up is equal to 47,21,435 divided by 4,72,000. 003. Yeah, okay. See, sir, that is 10.003 means 003 is too small. Okay, so we'll round it off to 10 contracts. When we will accept it as if it is full hedging. In that again, under hedging and all, 1,000 rupees where will hedge, sir? Leave it. Too small. Margin money payable is equal to 10 contracts into rupees 15,000 per contract, 1,50,000. Even though this is outflow today, this money will be given back to you later on. So your real cost is only the opportunity interest cost. Margin money payable today and sponsor. Also put a arrow mark under it, will be released on exit from futures. So you paid and they'll give it back to you. That's all, sir. Today ka drama over. Directly move on to maturity date or on 1st of September. Okay, first what should we do? Receive $1 lakh from customer and convert into rupees at prevailing spot rate. Did the question give you spot rate on 1st September? So using that rate I can convert it. Okay, don't convert, just write the point. I'll tell you why you should not convert immediately. Second point, what else you have to do on 1st September? You took futures contract which is expiring at the end of September, but 1st September to risk is completed. So what you have to do? Exit. So exit out of futures market on 1st September. Tell me, sir, what is your original position? Long or shorter? Long at the rate of 1 rupee is equal to $0.02118, I guess. Action for exit. Go short at 1 rupee is equal to, what is the price now? 2134, huh? Futures price. Quickly compute gain or loss. So sell rate minus buy rate. Sell rate is short position rate, sir, which is $0.02134. Buy rate is $0.02118 into how many contracts did you pick up? 10 contracts. Each contract value is rupees 4,72,000. Sort out this. Definitely plus only, sir, because sell rate is higher. You will have 755.20. What is this? Rupee or dollar? Sir, Forex we did for how many classes, you know? Tell me, sir. Rupee or dollar? 1 minute. Answer is printed. No. Now tell me. If it is rupee, how rupee you have to convince? If it is dollar, then I will not ask. Dollar. Sir, if it is rupee, you have to convince. Why it is rupee? Not rupee, dollar. Yes, sir. This is what, sir, this one is what, sir? The long position rate of 1 rupee at this price. So the dollar 0.02118 per rupee. So idi per rupee, outside numerator rupee is there. They will die, sir. Effectively answer will be in dollars. Gain, not just gain, inflow.
when you make mistake also, మిస్టేక్లో కూడా ఒక రేంజ్ ఉండాలి సార్. మరి వీడి చేతిలో చచ్చిపోతే ఎట్లా సార్? ఓకే, వాట్ షుడ్ యూ డూ విత్ దిస్ గెయిన్ నౌ? You are not in foreign company, no. Means you are not a dollar company. You are an Indian company. So dollars also you have to convert into rupees. At what rate? Spot rate. Now you see here. Correctly understand what I am trying to say. First step lo inflow is there. Dollar inflow. Second step lo also dollar inflow is there. Total dollar inflow you have to convert into your home currency at the prevailing spot rate. Fine. Sir, can I do individually also? I mean, here I'll do conversion. Here also I'll do conversion, and I'll add up these two. That also will give me same answer because same rate will be selected. But why I did not do individual conversion is, imagine sir, here inflow is coming, there is no doubt. Suppose instead of gain, suppose you suffered a loss, so you have to pay money. And imagine question lo bid rate, ask rate are separate. Sir, you have a FC receipt today, FC payable today at spot, and there is bid rate, ask rate. Based on your forex knowledge, you know that netting off is better so that you can avoid the bid ask spread ka loss. So in that case, what I would have done is 1 lakh inflow is there, 755.2 outflow is there. Net I would work out the net inflow. That alone I would have converted at spot rate lo bid I would have applied. Adi if you do individually, for this bid will be applicable when you are selling dollars, but when you have to buy dollars for making a payment, ask will be applicable for. Ee sum lo all the drama is not there because అది single quote. Ee sum lo whether you do individually, combinedly, answer will be same only. One gain, one loss, anything answer will be same because as long as it is a single quote. Next sum it won't be like that. So you have to prepare for the worst and you have to plan. So right sir, third point. Total FC receipt is equal to 1 lakh dollars plus 755.2 US. Spot rate on 1st September. $0.02133. 1 lakh 755.2. Convert this. Individually if you do also same answer will come, but it is safe. 20 point. I'll leave it. Fourth point, right? Margin money paid will be released. Rupees 1,50,000. Opportunity interest cost on margin money blocked for 3 months equals to, go and see the question, some interest rate is given, 3 months transaction, 8%. How much? 3,750. 3,000. Therefore, net inflow in futures hedging is equal to 47,23,638 minus 3,000. 3,000 is as good as loss only, no? So it's 47,20,638, which is your ultimate answer. What happened? No? Which future value? I didn't get you. Somewhere mistake I did, huh? How much did I write? I wrote only future value. Okay, I'm sorry. This should be correct. You are right. Only the interest cost no, we are writing. It should not write the future value. Forward ka inflow was how much? 47 lakhs. This is 47 lakh 1000. This is 47 lakh 20,000. Definitely this is better. But there is another alternative. Till now they did not give one question also where options, futures, both hedging they asked. If I am examiner, that will be there. One best of luck limited and this L club. Half an hour, 45 minutes at time pass. What is alternative 3? No hedging. Sir, no hedging means what should I do? Just convert at spot rate. $230. So write the conclusion, sir. Sum is over. Which one is better? Forward contract, huh? Futures is betting. Okay. Hedging should be done. Sorry, don't write like that. Write like this. Futures hedging is most advantageous to the company. Each sentence is more appropriate. What is not technically correct is select futures contract. Align is not right. Why not right? Sir, you are standing today at what time? 3 months time. After 3 months, what spot rate is prevailing? If that is given in the question, how did he know? If you are standing on day 1, what is the exact spot rate? That should be either expected rate. But he did not say it is expected rate. He very clearly told that on September the spot rate is. So you should not write select this one because already some decision they would have taken. The post-mortem. Once entire 3 months is over, you are just looking back. Who was better? Okay, which would be most advantageous? Not which one will be selected. Question on flaw, he covered it like that. Good. Zaz. Zaz only you do. 9th question, please. Zaz PLC, a UK company, is in the process of negotiating an order amounting to Euro 2.8 million with a large German retailer on 6 months credit. Stop there. You are a UK company. You are negotiating an order worth Euro
Okay, 2.8 million, 28 lakhs. It కాదు, if successful, this will be the first time for Zaz has exported goods into a highly competitive German market. Now clarity వచ్చేది sir, the export. So the receivable sum. Zaz is considering three following alternatives for managing the transaction risk before the order is finalized. So there are three people giving their ideas. Let's see. A. Mr. Peter, the marketing head, has suggested that in order to remove transaction risk completely, Zaz should invoice the German firm in sterling. What is sterling? Pound. In sterling, using the current euro per pound spot rate to calculate the invoice amount. So what is Peter's idea is, so don't take risk. Don't invoice in euro. Invoice in pound. If you invoice in pound, what will happen? You are a UK company. Invoicing in pound means what? Foreign exchange risk got completely eliminated. For that, which rate you have to use is take today's spot rate, work out the equivalent of 28 million euros in pound terms, identify that as the invoice amount. This is an alternative. That means, I'll eliminate the risk completely by doing a home currency invoicing is what he is suggesting. First fellow. Second guy, Mr. Wilson C, Chief Executive, is doubtful about Mr. Peter's proposal. Sir, why he is doubtful is generally when you try to invoice in your own home currency, the customer may find some other supplier because he won't. General customers don't like risk. So Mr. Wilson C is doubtful about Mr. Peter's proposal and suggested an alternative of invoicing the German firm in euro and using a forward contract to hedge the transaction risk. So this fellow is saying that let's take a forward and we will only bear the risk. C. Ms. Karen, CFO, is agreed with the proposal of Mr. Wilson. See, she accepted. 2. Invoice the German first in euro. That means invoicing will be done in euros only. But she is of the opinion that Zaz should use sufficient 6-month sterling future contract. Sterling future means pound. Pound future contract to the nearest whole number to hedge the transaction risk. So first one is home currency invoicing, second one is forward, third one is currency futures. That too, which currency futures also clarity is there. Pound futures. Underlying asset is pound. Following data is available. Today's spot rate given. 6-month forward points 0.60 and 0.55 euro cents. Swap points are swap points. Swap points, what you should do? You will add to the spot rate or you should minus from the spot rate. The result will be forward rate. Here which one you have to do? Minus or plus? Sure, because they are in decreasing order. Where will you adjust that? First 2 digits, last 2 digits. Sir, if it is like this, add అరే అంటే క్వశ్చన్ కూడా మీరు ఎక్స్పెక్ట్ చేస్తారా సార్? 60/55 అంటే ది స్వాప్ పాయింట్ సార్. లాస్ట్ 2 decimals you have to adjust. But what is given there is not 60/55. వాడు స్వాప్ పాయింట్ కా కరెన్సీ స్పెసిఫిక్ యూనిట్ కరెన్సీలు ఇచ్చాడు సార్. You remember we did sums where $1 is got so many rupees. Swap points paisalo they gave. So paisa I have to convert into rupee terms and then I have to adjust. Ultimately your answer is right, but that is pure coincidence. Continue. 6 months futures is currently trading at futures price is given. 6 months futures contract size until lot size is given. Spot rate and 6 months futures rate. That means on the maturity day both will be same. No, our rate is this. You are required to calculate to the nearest pound until leave chiller decimals and all. The pound receipt for Zaz PLC under each of the 3 above proposals. In your opinion, which alternative you consider to be most appropriate? Obviously, wherever inflow is higher, I'll select that. In this sum, one small mistake is there. Mistake in the sense, solution mistake is there. I'm not responsible. I'll tell you what is that number mistake. But judgment is yours. Whether you'll follow ICA or you'll follow your own judgment. Okay? Right. Question number 9. What's the first alternative? Alternative one is Peter. Peter, what is he saying? Home currency invoicing. Value of FC receivable is 28 lakhs euro. We have to calculate pound equivalent as on today and invoice the German customer in pounds. So do one small correction. FC receivable in our road, sir. This is wrong language. Value of order and raskon, sir. Because ultimately FC receivable won't be there in this sum. In this alternative, sorry. So go right. What is the spot rate? What's the presentation? Euro per pound. Okay, 1 pound is equal to euro 1.1960 and 1.1970. Between these two, who? Fast, 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 fast. Which one, sir? Bid or ask? Okay. Sir, what you have to assume is, if you receive this many euros today only, how much pound will you receive? That much amount I will invoice and I will agree to receive after 3 months. That's what idea. So if you receive euro today only, a euro will give it to the bank. From the bank you will take pound. Left hand side quotation is given for pound. So I am taking pounds, so bank is selling pounds. Which rate? Ask rate. So 28 lakhs की corresponding value. 23 lakhs 181, no? Okay. Now you see, it looks as if I received 28 lakhs today only and I am converting at spot rate. Not like that. The equivalent calculation get it. So, right, we should invoice customer at pound 23 lakhs 39,181 to be received 3 months from today. 3 months only, no? Yeah, that's what, 6 months. Option 2. Forward hedging. Sir, if you have to do forward hedging, first you should know the forward rate. So, spot rate 1 pound is equal to euro 1.1960 and 1.1970. If you are pro, you are able to think everything correctly. Directly also you can do. There is no need to write small steps like this. Since you are not pro, I am writing.
Why swap points you have to minus? They are in falling order. In one exam question, what that stupid did is this. Look at this correctly. 6 months forward points are in which order? Falling order. So definitely you have to minus. At exam ఏం చేసేయండి సార్ 6 month forward points premium అని రాశాడు సార్. Error obviously. How can that be premium? If swap points are in decreasing order, then means the currency is at discount. But he wrote the term premium there. Question framing error, sir. What should you do? What will you do? You will do what is based on what is there here. Ideally, are they correct? Or you may say that, sir, the premium is, sir, he wantedly gave it in reverse order. Ideally, they should give you marks if you make such assumption and all. But it is a questionable mistake, sir. Of course, not in this some other case. Swap points. Now, how much you have to minus? Leave a couple of lines and put a star mark here somewhere and come. Sir, a swap points will be in which currency? Ante left hand side currency or right hand side currency? Doubt. Right hand side currency. So 1 euro is equal to how many cents? 100 cents. Array cent is obviously belonging to euro, no? Pound it is penny. 1 euro is equal to 100 cents. How many cents is he talking? 0.60 cents is how many rupees? Sorry, how many euros? Sort out 0.0060. Similarly, yes, sir. Go adjust this now. 0.0060, 0.0055. You should not remember like that first two digits, last two digits, and swap point interpretation and all is written. Should be careful. Very careful, very scared in fact. 6 months forward rate. 1 pound is equal to euro 1.1900, 1.1915. Between these two, which rate? Again, already whatever rate is vector, other rate, ask rate. If you want, you can draw the diagram and see for yourself. 1 pound is equal to euro 1.1915. How many euros? 28 lakh euros. $23 lakhs, 970. This is your inflow at 6 months time. You can check the answer, sir. They presented the sum in millions. So first one you got 23,39,181. He called it as 2.339 million. This one you got something, he called it as 2.35, but actually you got 2.34997, so that's 2.35 is fair enough. Come to alternative 3. What is alternative 3? Futures hedging. Anyway, to hedge the risk in
euro receivable, ZAS will take, this time no diagram, inside only. Tell me, short position, long position. Pound futures you have to do. Our clarity is there. Question he told no. So that you need not judge. Position you judge. Long position. Why long position? Sir, I will receive euro. A euro I will give it to the bank. So risk is what? Euro may fall. And from the bank I pick up pound. Risk is what? Pound may rise. I have to hedge using pound futures here. So rising market low, long position. To hedge the risk in euro assets, ZAS will take long position. In pound futures available at the rate of £1 is equal to euro 1.1943. Okay, 1 point, that much. Next question. Did the question give you lot size? Check. Lot size is that definitely you have to work out the number of contracts. Now how many contracts you should take if you have to do hedging of 28 lakh euros? Because your FC is in 28 lakhs euros, but lot size is in pound. So what I have to do? Convert. Conversion, which rate I have to use? E-futures pricing. So right, 28 lakhs euros is equal to how many pounds? $470. 23 lakhs 44,000. 470. Okay, nice. So this much value you have to take. We have to take long position worth 2344 470 pounds to hedge euro 28 lakhs receivable at 6 months time. Now write what is your lot size. $62,500. What is that? Pound. Number of contracts. To be taken up. How will you know? 2344 470 pounds divided by 62,500 pounds per contract. So answer will be in contracts. Exactly tell 37.5. Okay. Now read the question correctly and tell me how many contracts you should take. Nearest to whole number means who? 37 or 38? Pakka no? Look at the answer. He took 37. He took 37. Because of that answer will change off. Because gain or loss on maturity date will change. You know, you will be doing for 38 contracts or 37 contracts. Sir, as far as my basic knowledge in English says, nearest to whole number means whether it is lower or higher, whichever is in less distance. So 37.51 ki 38 is the closest number compared to 37, correct? So ideally you have to take only for 38. I say answer 37. Even today in study material it is at 37 only. He could have said to the next level whole number or that to the next integer in some question we did not like that. They should tell you. So what should you do, sir? That's Sanjay. Right, sir. Round off to 38 contracts. Brackets rate next or not next, nearest whole number. Also I'm writing ICA took 37 contracts. In suggested answer and also in study mat. So those who don't want to take absolutely no risk, remember this answer. So if you do in millions, answer will change. Huh? No, answer should not change anyway. He also did that only. ఇది జోక్ అంటే 23 44 478 divided by 62 500 37 and he writes brackets lo he also wrote this. So like that it is. So leave. So some contracts you took. Sir, you can take 37 if you want. Okay, there is no compulsion that you have to follow me. Mohammed Bhatt, sir. But what is wrong at 6 months. At 6 months you have to do two things. Receive converted spot rate and settle futures also. Two things you have to do. A. Receive from customer euro 28 lakhs to be converted into pounds at spot rate. B point. What else you have to do? Settle. This time you need not exit and run away and all, because this is not premature settlement. Settle gain oblique loss in futures. So we took long at 1 pound is equal to euro 1.19. What was that? 1943. Today spot rate is 1 pound is equal to euro 1.1873. You will tell me gain or loss? Definitely loss. Why loss, sir? I agreed to buy at a higher rate. Eventually it turned out like that. So loss. Loss is equal to 1.1943 minus 1.1873 euros. This is loss per 1 pound. Into how many contracts did you pick up? 38 contracts you picked up. Each contract, how many pounds are there? 62,500 pounds are there. 16,000. Which currency is this? అంటే ఒకసారి చేసినా మనకు బుద్ధి రాలేదు సార్. కరెక్ట్ చెప్పండి. యూరోనా పౌండా? అరే బాబు, ఇన్సైడ్లో వాట్ ఎవర్ ఇస్ అదే ఆన్సర్. బై హార్ట్ అట్లీస్ట్. ప్రైస్ ఏ టర్మ్స్లో ఉంటుందో ఆన్సర్ అదే. ఆ ప్రైస్ కెన్ బి ఫారిన్ కరెన్సీ ఆల్సో, డజంట్ మ్యాటర్. Inside brackets or whatever is there, gain or loss will be in that model only. What is this now? Euros. Loss. Loss means not feeling loss. No, you have to pay. Payable today. So in A bit you are having an inflow, B bit you are having a outflow. Net inflow you will convert. Independently also you can do, because anyway that's a single quote now. But if it is a two-way quote, you will be in trouble there. net inflow in 6 months is equal to 28 lakhs euro minus 16,625 euro. Sort out this. Yes. Spot rate today, 1 pound is equal to euro 1.1873. Once again, 20 to 9. The answer won't match for obvious reasons. We got 23,44,000. He got 27 lakhs. He got. No, not 27 lakhs. He got 23 lakhs 44,000. He got. We got also 23 lakh 44. But after that, 6 he is having. We are having 29. The difference. Why that difference has come is I took 38. He took 37. And futures contractor loss came. So I suffered more loss by taking 38. So my inflow is little lower compared to his inflow. Ideally, they correct, sir. What should you do? Write the conclusion. Who is better? Forward is better. Huh? 2344. This is 2349. 2339. 2349. Huh, second one is better. Correct. Over sir, 10th one completed, 9th also done, 11th already completed, 12th one. Come to 12th question. Same question, sir. There is no difference. In this sum only, I corrected it, but originally, sir, it got printed like this. 6 months forward points premium unprinted, and they gave you this in decreasing order. So you have to, sum is same, numbers are slightly different, that's all. This one you handle, sir. Today in your ICS study mat, this sum is here. The examination question, RTP question, sir, this correct. This question study mat lo, what he did is, he retained this term premium, he changed the order here. Sir, so he changed that. But what came in the exam, what is there in RTP is this. Of course, what is there today in study mat is reverse of this. In that case, simple, sir. While calculating forward rate, instead of minusing, you have to add. That's the only difference that will come because of that. Anyway, this question ki answer correct. So go through it. It's the same stuff. You can write here, same as the previous question. One more question where he's asking hedge efficiency. Yeah, come to question number 8. For imports from UK, Philadelphia Limited of USA owes pound 6,50,000 to London Limited payable on May 2004. Okay, that's quite deep. Understand, sir? You are Philadelphia Limited of USA. You owe means definitely this is a FC payable, that too in pounds. Payable in May. Today is in February. Spot rate today is given 1 pound is equal to so many dollars. The following futures contract with lot size of 60 to 500 pounds are available on Philadelphia Exchange. One is March futures, one is June futures. Stop there. You want hedging up to what date? May ending work you want hedging, sir. May 2004 means assume that May ending. March futures, if I take, that will expire in March only. So definitely that is useless for me. I have to take what? June futures, and once my hedging period is over, I have to get out of my June futures. Show how Philadelphia Limited can use future contracts to reduce the transaction risk of, is not of, sir, if on 20th May is your ultimate settlement date. Here also you add 20th May, sir, it's wrongly printed, or maybe question of wantedly they eliminated that. Payable on 20th May. The payable on 20th May, last lo only you identified. So anyway, so you will take futures contract of June and you will handle, sir. 20th May spot rate is given because ultimately you have to buy pound only in the open market, and June futures are trading at some price. June futures ka price, why did he give you? You have to exit, no, that's why. Normal question only. Second bit, calculate the hedge efficiency. What is hedge efficiency? I have to tell you, otherwise there is no point of doing this question. It's just like the previous sum only. Just a second part goes on, I have to solve. Start. You do. You have 6 minutes. Hint is March futures is waste. And don't see the answer. Because when you come to such stage, I'll make an assumption for you. Draw diagrams are, you are USA company, you have a payable in pound, you have to buy pound by selling dollar. What is risk? What are the two routes? Who is underlying asset in the question? Thinking should be like that, whether you write that or not. So which position? Good, long position.
1.4960. Number of futures contract. Taken is equal to. Sir, tell me, your FC payable is in pounds. Lot size also is in pounds only. So therefore, you need not convert the numerator. In previous two sums we converted. How much is it exactly coming to? 10.40. Sir, listen. When it is 10.40, you can either take 10 or you can take 11. Question or no suggestion is given. So it's up to you. You will take 10 or 11. What will you do? On the maturity date, spot rate is available with you. Since the spot rate on the maturity date is available with you, you are at your license to do anything. 10 also you can do, 11 also you can do. I have printed one solution there where I'll see how much contracts I have taken. 10.4 work question, sir. 10 contra. I took 10 contracts here. Okay. We'll do 11 contracts. Assume, sir, 10 also is okay. Question given 10 ka solution. Assume company took 11 contracts. Brackets are it. Alternatively, 10 also can be taken. That's also today. Directly come to at 20th May. At 20th May. So on this day we have to do two things, sir. One is settle the gain or loss here. A. FC payable or receivable? Okay. Settle FC payable of 6,50,000 pounds by at prevailing SR. One-way quote, two-way quote? One-way quote. Anyway, B bit. Exit out of futures market. You don't have any job there because our contract, whatever you took up, will expire only in June. 20th May to your FC payable is settled. So why will you stay there? Get out. So for that, what is your original position? Original position is long at the rate of 1 pound is equal to $1.4960. Premature settlement, action to exit or square up or cover up, whatever language you use. You have to take up a short position in June futures. Short at 1 pound is equal to dollar. What is the short position rate? 1.5120. Definitely looks gain. 1.5120. It per pound gain. Like that, how many contracts we took? 11 contracts. Each contract was 62,500 pounds. So overall, how many dollars gain? Sorry. Yeah. Correct. Do. Did I do wrong somewhere? No, correct only I did, no? Do. Gain is how much? 11,000. What is this? Which currency? Dollars. Why did I write pounds here? You are a UK company, US company?
Your US company. Okay. I should have settled it there. I can't net off them. Why can't I net off? Futures contract lo gain is coming in your home currency only. That need not be converted. But EBIT you have to do at prevailing spot rate. So anyway. Okay, right. What is that? See. Outflow. 11,000 rupees rate inflow. Outflow for buying 6,50,000 pounds. What is spot rate today? 1 pound is equal to 1.50, sorry, correct, $1.5030. Okay, 6,50,000 pounds is equal to how many dollars? 9. What is this dollars? This is your outflow. Therefore, net outflow. The first bit answer, sir. This answer won't match with what we have done there. Here you got 976, 950. That's because, okay, not 976. Overall answer will be net of these two something. 976, 966 or something you'll get. The difference will be because there we took 10 contracts. Here I am taking 11 contracts. Because I took one contract extra, my gain also will be more. Because 11,000 I am getting. If you take 10 contracts, you will get 10,000. So our difference will be there. Anyway, don't bother about that. Come here. Second question important. He is asking something. He is asking what is the hedge efficiency. Guys, listen now. The entire objective of hedging is the loss in one market is getting compensated with gain in another market, correct? So he is asking how much proportion of gain is compensated, means how much proportion of loss is compensated in the form of gain. Meaning what you have to do is, so original how much loss did you suffer if there was no hedging? Because of hedging, how much gain you got, and express gain by loss into 100. So for example, look at this. Futures market you did some hedging action. Ultimately you got what? Gain or loss here? Gain. Are you happy? Sad? No feeling. No feeling. Why no feeling? You are not speculator, sir. You are hedger. If hedging action lo gain came means normal transaction lo definitely exchange loss would be there for you. Correct? So you have to work out how much is that exchange loss. Compare that with this exchange gain and see how much percentage of that loss got recovered through your hedging action. Adi hedging efficiency meaning. So, right, sir. It expresses the amount of loss recovered through gain. In percentage terms. A. Spot rate on, what's the first day spot rate? When you make the sale, first day he has given, see. Spot rate on 12th February. 1 pound is equal to $1.4850. So on day one, each pound ka worth is only this much. But spot rate on 20th May, I am buying in open market only, no? So open market each pound I had to buy at what rate? 1 point above only you wrote. 5030. But pound payable you are having and pound is increasing, definitely loss. Therefore, exchange loss in transaction, definitely exchange loss, is equal to $1.5030 minus $1.4850 into how much is it? 6,50,000 pounds. And $11,700. Pakka loss, there's no doubt. B, gain in futures market. Again you did not compute, already computed. How much gain did you get? $11,000. So in one market you suffered loss, another market gave you gain. He's asking hedge efficiency, means how efficient your hedging is. Percentage terms you have to work out. Hedge efficiency percentage is equal to, formula is like this: gain in one market divided by loss in another market into 100, of course. Sir, which market? Like that rule is not. It's not like hedging ka result should be in the numerator. Not like that. Gain by loss is the answer, because what happened is really loss happened and futures protected you. Reverse also is possible, no? In that case, futures or loss will come. Cash market protects you then. So one will protect each other. Insurance. Work out the percentage. The 190 0. So your hedging is this much efficient, 94.02%. If you take 10 contracts, then your answer would be 85.47%. Why less hedging there? Because futures contract you are getting a gain. I took 11 contracts, I got 11,000. If you took 10 contracts, you will get only 10,000. So it's your choice, sir. You can take 10 also, 10 is not wrong. Okay. So 10 ka answer printed, 11 ka answer here brackets are written. So that is about question number 8. Sir, question number 13, we'll solve it in the next session anyway, it's a little lengthy. The question number 13 is actually not directly related to futures, but it's similar to futures. It is called as an NDF, called as a non-deliverable forward. But means forward contract only, but forward contract delivery is not there. Sir, then why to enter into forward contract? Why did you enter into futures contract when delivery is not there? Same reason. NDF also same purpose. So NDF sum actually was printed in your forex chapter also. I told you that I'll cover you in options hedging and futures chapter hedging. So here we got to cover, but we'll do it in the next session, sir. Easy only, just that should be a little careful. But for that, I think the rest of the questions are done. Maybe one more question is there. We'll see. I achieved some, sir. Because I'll see you in the next session.